So welcome friends to another episode of Building Blocks. Today I am fortunate enough to have with us Bhupinder Singh from RBC. He is famously known as Bobby as well. Bhupinder has been a great help to our clients in past few years. One of our clients only introduced me to Bhupinder.
Yes.
And the best thing which I like about Bobby is that he is very prompt in his approvals and very thorough in his work. So thank you so much for your time today.
Thank you,
Bobby,
Mudit.
I truly appreciate you coming here.
No, thank you for inviting me on this. Thank you.
Pleasure. So I have some list of questions for you. Some queries which generally people will have for mortgages.
Sure.
So the first one is a basic one, that when a mortgage loan application goes to a bank, what the bank sees for the application before approving the loan? What
Okay.
all you see in application?
Usually before, for the approval of the mortgage for any client, we want to see three things, right? One, their income. Second, how good their credit are and how established the credit is. And third is a down payment. So usually these are few parameters. We assess the client based on that. And based on that, we run all the qualification for the mortgage approval.
Okay. And when we talk about income, is that there is a benchmark that they have to be employed for 1 year or 2 years or 4 years?
Yeah. So in this case, how this works, if the client is employed, he has to be full-time employed at least for 3 months,
Okay.
right? In order to get the mortgage approval process. And if the clients are self-employed, they have to be self-employed for at least 2 years with their declared income to the CRA. So is self-employed, minimum 2 years, employed, minimum 3 months.
Okay. And so that's the basic thing what you look at.
That's right.
And if someone is in a private business kind of, so then notice of assessments you need for 2 years.
So those clients for us, we call as a self-employed, who
Okay.
are there doing their own thing. And for them, we used 2 years average. I just want to add it here one more thing. If the client is working employed, but based on the part-time basis, right? So in this case, we see either 2 years average income for the part-time job. And if they're not 2 years working, then we want to see their guaranteed hours, like how much guaranteed hours they are getting. So we can use their income as well.
Okay, I understand. And if a person is employed, but he or she is in probation, so would that impact their getting
Yes.
approval?
So now this is something is exceptional based. So how I see in the banking industry through our underwriters, if the client is putting less than 20% down payment, so they want to clear the probation first, because insurer will not guarantee this deal until the probation is over. But at the same time, if the client is putting 20% down payment, it's now is bank's own call. Or based on that, what they see, if the client is working in some other company and they switch over to the higher income job, like they have a good industry experience, then we got exception to that too.
Got it. So it's basically case to case basis, underwriter will take a call.
Exactly, based on 20% down payment, but not on below 20%. They have to clear the probation for sure.
Yeah, sure. So now the next one is again a very popular one. So what is difference between a fixed mortgage and a variable mortgage? Just for a layman, like if some of our viewers don't understand this jargon, fixed mortgage and variable
Okay,
mortgage.
that's right. So, I'll tell you as a layman then. So if you see lots of people, clients calls, oh, the Bank of Canada is changing the rate. What will happen to my rate? The rates are increasing. So when Bank of Canada go for the rates, they just settle the prime. They just establish the prime. Okay. And the variable rate mortgage goes on the prime rate, right? So that doesn't mean the fixed rates are also changing. So there is two segments in this case. One is a variable rate, which drive through the prime rate, which is established by the Bank of Canada. And one is a fixed rate, which based on the bond market. And those are the fixed rate is two different things. And the difference between these is since this is variable, it tells us it's a fluctuate rate. If the prime goes up, the client's rate will go up as well. The prime goes down, the client's rate will go down as well. Whereas in fixed rate, once client choose a term, for example, they choose 3 years rate, no matter what the rates are going in which direction, clients will stay with that rate for next 3 years, whatever the term they chose.
And in variable, there is something called prime -2 or prime -1 or prime plus 0.5 or prime minus 0.4, whatever. So that's a discount.
So in variable rate, depending on the variable is two types. Sorry, one is variable closed, one is variable open, and then there's equity line of credits as well. So most people, I would say, whenever they buy the house, if they choose variable rate, they choose close to variable with subprime. It's prime minus 20 off or 30 off, those kind of rates. If the client is a dire situation or they want to just close the property and they're planning to sell in next 3 to 6 months, usually they go with the open variable. So they have to avoid the penalty on that. And the variable open rate is always prime plus. These days is going close to 9%, which is quite high, but it's again, there is no penalty. And this is for the time being financing arrangements.
So for close variable, you mean to say the penalty is much higher than the open
It's 3-month interest. Variable mortgage penalty is always 3-month interest.
Okay.
So while we're touching this penalty part, I can just add it fixed mortgage penalties as well. That in the fixed mortgage penalties goes as 3-month interest or interest rate differential, whichever is higher, depending on when the client is selling the property, and if they are not porting that mortgage to the new property, then they have to pay the penalty.
Okay. Fair enough. And in the current market, as you know that in 2022 we had 7 times the interest rates were increased,
right,
and then
right.
in 2023 so far, I think January 7th they increased 50 basis point, and then January 25th it was 25 basis points.
That's right.
So now we know that 9 times it has increased, but now it looks like Bank of Canada is holding on to rates at this point in time.
Yeah, so the basically what they're doing is they're trying to contain the inflation. So if you see yesterday, the new inflation number came in at 4.3%, which is technically a good news for us as well. They are targeting below 3%. And after that, we'll start seeing this, that potentially our RBC economists start saying that they will start dropping the prime from current stage as 6.7%. So right now, what the trend is, variable rate is too high. So if you ask me what the client are deciding, so they are doing lots of Google research as well. They are hearing to other economists as well. So the predictions are the rates will come down in the range of 4.5% down the road in 2 to 3 years. So what I see the trend into the clients, and when the client asks for our advice, so we are asking them to go for the shorter term fix, kind of 2-year fix or 3-year fix kind of thing, so that it's kind of win-win situation for them. They can fix the rate, no surprises. At the same time, by the time 2 years or 3 years when the mortgage coming on renewal, they can secure the new lower rate for the renewal time.
Okay, so that's what recommendation these days.
That's right.
Okay. And when, as a consumer, as a investor, or as a buyer for my own home purchase, when I want to apply for a mortgage, what all documentation I need to supply, or what all documentation you will seek from me?
Yeah. So
a list of documentation.
Yes. So as we discussed, there's the 2 kinds of clients. One is a employed clients, one is a self-employed clients. So for employed clients, what we take there, we take their recent pay stub, their T4 for the most recent, in this case T4 2022, and certain cases we ask for job letter as well if the client is less than 1 year old in that company, right? And to support that, sometimes we take the direct deposits from their bank account. This is for the employed clients. Okay. If the client is self-employed, first of all, we have to establish they are self-employed, which we can get from their article of incorporation, right? So once we establish the client is self-employed, then for the income purpose, we'll take T1 journal and notice of assessment for the most 2 recent years. Okay, in this case, right now we are taking between 2022 to 2021 or 21 and 2020, depending on have they submitted the tax or not, because we are still in the middle of tax season.
Right.
But yes, so self-employed T1 journals and notice of assessments, and employed recent pay sum and T4 is a main documents for us.
And of course, credit check is automatically done by the bank.
We do our own credit check, and for the mortgage approval purpose, the other thing is we want to see the down payment, which is coming through the 90 days history. So we take their bank statements. They might have the money in their RRSPs, being a first time home buyer, their TFSAs, their check-ins or savings, so wherever they have the money, we take the statement with 90 days history. Right. And once client find the property, we run the appraisal of the property, and then these are 3 critical parts which is required for any approvals of the mortgages.
Right. Yeah, thank you. And I often, there are 2 terms where clients often, get confused: pre-approval and pre-qualification. So is there a difference between these 2?
If you ask me, no, there is no difference. It's the same thing. This is a different way to put this one. And if you want to put more into the deep discussion, Pre-approval, I would say the formal pre-approval into the system where we verify the income, verify the down payment, pull the credit bureau. The only missing piece is the property.
Right.
And pre-qualification, sometime I can say, okay, I'm sitting with the client, I'm not starting the application, but reviewing all those documents, doing my manual calculation. I can kind of give an idea, okay, you pre-qualified like this. But ideally, I encourage my clients to go into the formal pre-approval so that we have a more true numbers, because they are going to make the biggest purchase of their life and they want a right advice from us.
So I guess what the takeaway, what I can see is that if you are looking for a firm or a clean offer for a property, it's better to ensure that you get a pre-approval.
It is very important because clients should know what limit they can qualify before they enter into the market. Because if sometime client is qualified for say $800,000 purchase and they're looking at property of $1 million, right? Or sometimes they're looking for property only for $600,000 and they wish to buy for $800,000. So by doing this process, they know where exactly they stand, and it's very helpful for them as well.
True. So the first process, I agree completely with you, should be getting the pre-qualification done.
Important.
And then only you start shopping around.
100%.
And then the next one, what I have here, Bobby, is that is there a thumb rule for determining how much I can qualify for a mortgage, considering that they don't have any liability or personal loans or educational loans? Is there any thumb rule which...
The honest answer, there is no thumb rule. And I'll tell you why. Back in, I would say 5, 6, 7 years back, we say whatever my gross income is multiplied by 5 or 5.5. Yes. This is my qualification.
Right.
Those days, there was no stress test. Now there is stress test rate. So we had to see, first of all, client's preference. They want a variable rate or fixed rate. Fixed rate, which term? What are the of rate we can offer? We have to add 2% as a stress test to see. Every time the rate is changing, their mortgage payment is changing, and that's impacting their qualification. So if you ask me personally, I will never tell my clients to go 4 times of the income or 5 times the income. I would rather do the calculation and see how much they qualified for.
And then stress test is same for variable mortgages or fixed? Or
yeah, how the stress test is working, whatever we are offering actual rate to the client. For example, if the client is taking variable rate, it is prime minus 0.3%, which is 6.4 effective rate. So we add 2% on that, so which is 8.4%. The client has to qualify based on 8%, 8.4% payment, and then we see the qualification. Versus client is taking 3-year fixed rate, say 5.20%. I'm just throwing example. This is not a true number. So we add 2% on 5.2%. So now client is qualifying at 7.2%. This is very interesting. 8.4 for variable and 7.2 for the fixed. 1% makes a big difference into qualification. So that's why there is no thumb rule. Personally, that's my belief.
Okay, got you. No. I think that makes it clear, this example. So now the next one, what I have here, Bobby, is that is there any program which RBC has for self-employed individuals, some special program, or for that matter, newcomers coming to Canada?
That's a very good question. I'll tell you. So let's talk about the self-employed clients first, right? So then I will give you the other one, newcomer too. The self-employed clients, how this work. Now, depending on self-employed, the critical payment thing is what the down payment client is putting up. So sometimes clients say we are putting 35% down payment. So we have a program for the self-employed equity, which we state the income. Client is earning say $200,000. On the paper, they are showing only $50,000, but they are putting 35% down payment. So we have a program where you can multiply their income, declared income by 3, and we can use 150 legit income, depending on the business. That's a part one. If the client come as a standard program for the self-employed, then it's a straight away T1 general annual declared income. We go with that. Sometimes clients are self-employed and they want to put less than 20% down payment. So those are very, we have to establish which business they are in. For example, if I give you, if the client is running a convenience store, where is lots of gross income and lots of cash component into that, where we cannot identify the client how much client is earning. So for them, there is a Genworth program, which is an insurance company. Now the new name is Sajan. So they do Alt A program. So we can gross up income. Though they are putting 10%, but we can gross up the income. They charge a little bit higher insurer fees, but the client can even buy with less than 20% being a self-employed. As compared to this, if this client is in trucking business, and we see their business account, their regular payment is coming. So there's no cash component involved in that. So we cannot fit that client into that program. But grocery business or saloon business, anywhere where there is a cash component involved, so we can do that one as well.
Okay.
Regarding newcomer, we have 2 or 3 different programs. First of all, if the client is brand new, landed, say maybe 2 weeks, 3 weeks, they can still get a mortgage without any job, as long as they are putting 35% down payment. Plus, they can show 12 months principal, interest, and tax payment as a saving behind them. So they can get the mortgage. If the client is newcomer and they just started working here, say 4 months, 6 months, and they are less than a year old in the country, we can still try to establish their credit reliability through either their back home, say wherever the country they're coming from, or from their bank statement if the client has a good, healthy banking relationship established in their back home. So they can go even with a less than 10% down payment as well, 5 and 10's combination. And if the client is, say for example, they are here from last 2 years and they are working, they are putting 20% down payment, we see their potential of earning, how much they are, and we can still offer exceptions.
So what I'm hearing is that if a person is new to Canada and they don't have job yet, but they do have sufficient
35% cash, and that's for RBC. I can talk about RBC. The policy says, they say 10% has to come from the own saving. The rest can be gifted from parents as well, or the family as well. So if they can put 35% down payment, let's assume your mortgage payment is $3,000 and their tax is $5,000. So we calculate their annual mortgage payment is $36,000 plus 5,000 taxes. On top of down payment, they can show 41,000 savings. Good to go. So we see their credentials. Have they done the MBA? Are they IT professionals or the teachers? We take their degrees and we tell the client, our underwriters, that in next 12 to 18 months, they can establish to the threshold of that income. So underwriters, as per the policies, underwriters very comfortable giving those approvals to us.
Yeah, and that makes sense. So now the last one is very interesting one. So what inspired you to become a mortgage broker? And what do you like most about your work when you day in and day out you do this?
I'll give you honest answer. It's not made up answer. When I started this job, I was looking at my colleague and I was seeing that he's coming to the branch at 11 a.m. and leaving at the branch at 2 p.m. And this is a good job, right? But when I went to the job, this is not a 9 to 5 job. This is not a 3 to 6 job. It's a 24/7 job.
Much more than that.
And 7 days a job. Wow. It takes a lot, but at the same time, when all of a sudden you get a call from the client. One day I got actual thing. I got a call from the client right around 10:30 in this last winter. He said, Bobby bhai, right now outside snowing, my son is playing, fireplace is burning, I'm sitting here because of you. Right? So those kind of things, this gives goosebumps. I'm still having goosebumps like this. So when the clients say get a house and they trust you for the biggest purchase, there's a big satisfaction to me.
I hear you. So I truly appreciate your time today, Bobby.
Thank you.
It's a pleasure working with you always, and thanks for all of the support.
Thank you, Mudit. Thank you so very much for the invitation.
So, thank you, guys. And so we'll wrap up here and hope you liked the episode. And if you have any other questions related to mortgages, do drop in show note in comment section. And then we will try to address it in one of our next sessions. Stay positive and I will see you soon. Thank you.
Thank you.